Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, the UK's reliance on fickle foreign investors is a risk to gilts, says OBR chief. As well as that, we've got investors betting on rapid ECB rate cuts as economic look darkens. We've got lots to talk about on the charts, also with lots happening on the economic calendar. We'll come to that near the end, so make sure you stay around till you see that. Before we get straight into it, make sure you subscribe. But the first article to talk about, of course, is the UK's reliance on fickle foreign investors. Now, the UK's reliance on foreign investment in UK bonds is a growing risk to stability, and this is according to the head of Britain's fiscal watchdog, noting risks in the gilt market. Now, as we spoke about yesterday, there is growing risks within the UK's markets as a whole, with this largely stemming from, us emerging from, a period of economic uncertainty and, kind of this uncharted territory which we entered following, COVID, and that kind of period of shutting down the entire economy of the world, really. And this has created a kind of interesting situation in the UK, where lots of money has had to be spent on furlough and all these sort of schemes, which wouldn't have otherwise cost the government any money had there not been a lockdown. And as we've emerged out of that, not only have the Britain as a whole gained more debt, especially the government, of course, gaining more sovereign debt, but also the kind of way finance is structured within an economy has kind of changed a little bit, and now what we're seemingly seeing is this kind of ballooning debt within the UK, where more debt's been taken on over the past few years as a result of these kind of continued issues, kind of external issues such as firstly the financial crisis in 2007 and 2008, which kind of set the UK off on this kind of poor path with its debt kind of management. And then of course we've had numerous issues after that. Brexit didn't help, of course, with the kind of change in trade patterns and worries which came with that, creating issues for the UK economy, while in terms of debt wise, as well as that. And most recently, as I've just said, the key issue being COVID, which did balloon debt even further. And this is what the OBR chief is kind of talking about here, is that kind of ballooning debt and who is taking that debt on, who's buying it. And if it is those foreign investors, are they in for the long term or are they in for the short term? Because if they're in for the short term, how long are they willing to stay around? So the chair of the OBR yesterday said that a lack of information on overseas holders of gilts made it harder to predict their behaviour compared with domestic investors. And I guess that's just the case of working in an international economy. If you're taking on debt from, if you're taking on debt and you're selling, you're kind of you're promising to pay back loans to individuals which are on the other side of the world. Obviously, tracking these kind of transactions, tracking the individuals involved, is going to be a lot harder than domestic kind of transactions, with a quarter of government debt being owned by overseas investors, with this figure remaining relatively stable, whilst the government's overall debt load has ballooned over the past decade and a half. That's interesting to note, of course, as if debt has stayed at these kind of similar levels that we've seen, despite the ballooning levels of debt, how much debt's held by foreign investors, the fact that that stayed the same for so long is quite interesting to note. And the chances of that changing obviously pose a challenge, if it's kind of been stable for so long, and now due to the UK needing new funding, this share will have to grow, since there's a waning appetite for defined benefit pension schemes who are also big holders. So, these kind of other investors which we might usually rely on to take on the UK's debt, those being, those kind of benefit pension schemes, are no longer willing to take on that further debt that's ballooning, and therefore, the UK is having to look for those foreign investors. And it doesn't help that the DMO is now selling bonds at the same time as the Bank of England, because obviously this is creating, a massive increase in the amount of supply of, UK debt, which is making it harder, obviously, to get the right price, and as a result damaging the UK economy in somewhat, and this comes as central banks seek to reduce the stock of assets built during quantitative easing, because obviously during quantitative easing, going back to the COVID period here, this is when the central bank essentially buys up the debt within the market, therefore providing all these firms which usually hold this debt with liquidity, with cash, allowing them to spend this on investment and get business running, and stimulate the economy. But when you then start to unwind QE, you start selling off this debt which you accumulated during the COVID period. But obviously, if the Bank of England, but if the DMO at the same time is also, selling off this debt, you have two very big institutions selling off British sovereign debt, expanding the supply within the market, and kind of creating this level of instability, and therefore the chair of the chair of the OBR warned that DMO and Bank of England must coordinate closely in order to avoid flooding the market, with cues warning that if foreign investors are only looking for a quick return on interest rates for the time being, you'd worry about where they might go if the interest rates were to change. And that's the key issue: is, are these foreign investors, which are now required to take on all this debt, are they in for the short term or the long term? Because those pension funds are usually in for the long term. Of course, that's the way they're structured. But these kind of foreign investors, maybe just looking to kind of arbitrage, try and get the kind of difference in price and sell and buy or whatever different prices of sovereign debt, whether that be with the US, the ECB, and the Bank of and the UK. Because after all, the levels of interest rates has been ranging, in a sense of what people are predicting rates to fall to, and as we'll speak about in the next article, we actually talk about how these kind of predictions for where interest rates may be and where interest rates may be cut. We talk about that because that's very important to note, as this obviously kind of difference in speculation of when rate cuts may be implemented firstly obviously creates a kind of level of instability with buyers and sellers kind of getting into the market and getting out the market very quick in these kind of bond markets. But that's all to talk about in this article. Next article to talk about is the ECB. Now, investors are now betting that the ECB will be the first to cut interest rates next year, and this is a further sign that money managers believe officials over-raised interest rates. Now, when we have usually spoken about the ECB and the Eurozone economy as a whole, we've most often been highlighting, that dooming economic outlook. Not long ago, we spoke about the issues within the German economy in particular. But overall, a lot of this kind of issue has not only stemmed from COVID, that kind of COVID period where most of the economies in the world were shut down, but also the kind of continuing geopolitical issues within the continent as a whole, with obviously Russia's invasion into Ukraine, which is still continuing, damaging kind of the oil supply of the world, damaging supply chains further than they already were as a result of COVID, and therefore kind of creating this darkening economic outlook, as we have high inflation from the war and supply chain issues, and then we also just have high interest rates to respond to that, but that obviously causes stagnations within the economy. So the German economy has been struggling greatly. We've highlighted this especially within the German automobile manufacturing kind of industry that's been struggling greatly. So that's the main thing that we've been talking about in relation to the ECB. But of course, most recently we have seen the Eurozone inflation rate fall greatly, and this kind of sparked some optimism on rates being cut, and this is what we're talking about here. And in swap markets, the first rate cut for the ECB is now expected in March, with close to 6 quarter-point cuts by the end of the year being expected, which is a change from the 3 that were priced in November. This also reflects increasing nervousness about Europe's darkening economic outlook, with Eurozone inflation, of course, falling to 2.4% in November, which was the third consecutive downside surprise. That said, the core inflation rate still sits far above the 2% target at 3.6%, and this is all the whilst the Eurozone economy has been stagnant for most of the year. Now, investors were encouraged to double down on bets that will be early. That there will be early ECB rate cuts following dovish comments by a hawkish member of the ECB, who did say that the fall in inflation made further rate rises rather unlikely. And I believe we spoke about this already this week, as that did kind of trigger that sell-off for the euro, but also some interesting dynamics with the dollar as well. With the ECB also being set to meet next week, economists are expecting them to lower its forecasts for growth and inflation, further bolstering investors' belief rates will soon fall. In comparison, though, investors are pricing in the first rate cut for the Fed in May and 5 rate cuts by the end of the year. And as for the Bank of England, the first cuts are expected in June, with 3 cuts priced over 2024. Now, from that article, what can we decipher? Well, not only the things that I spoke about at the start, but also, we can start to kind of create this timeline for when interest rates will be cut for these major major central banks. With the first kind of interest rate cut being, of course, the ECB's, which is expected in March. Then we're expecting the Fed to start cutting rates in May. And then following that, we're expecting, the Bank of England later in June. And this is obviously all aligning with differing levels of inflation, with the UK still having the highest level of inflation out those 3 kind of economies, with the USA obviously having the second highest inflation and the Eurozone having the lowest. So definitely keep your eyes on this. That's all to talk about in relation to the articles, though. Next to talk about, of course, is the charts, where we are firstly talking about US indices. Now, US indices obviously have been, on the upswing since, the beginning of November. And that's what we've kind of highlighted as the main key point for US indices. But what we're currently seeing does seem to be this kind of ranging sideways movement for the US 30 in particular here. Now, we have highlighted before how, throughout this kind of bullish momentum to the upside, this bullish move to the upside, we've kind of seen price stagnate and consolidate and range along the way. And this was first highlighted around this period, quite near the start of November, to be honest, around the 6th, of course, till the 10th. And then we kind of saw it slightly repeated, but it was more so just continuing bullish momentum. And the main period of this kind of consolidation, I guess, would be the 14th to the 20th. But then from there, we kind of saw that slight movement to the upside, but it was still in quite a slow manner. And then we saw this continued uptick, and upswing, and now we're kind of seeing price consolidate again. What's interesting to note, though, is, of course, this kind of bearish divergence, which I may have highlighted before, I'm not sure, but we are making these new highs technically within this consolidation period. That said, we are kind of making lower highs on the RSI with this kind of very significant bearish divergence, as you can see here, where price was very, very, very overbought on the US 30, and therefore, it does seem that we formed this kind of bearish divergence. So keep your eyes on this, as there is a potential for a reversal. But of course, price action has previously indicated, price history has previously indicated that we do get these periods of consolidation on the US 30 before swinging higher further. So keep your eyes on this. It'll be interesting to see how maybe, the rhetoric from the ECB may affect this, but more importantly, how the NFP figure today will affect US markets, as understanding the NFP figure will help us determine how the US economy is doing, therefore how the Fed will situate its monetary policy and how that will affect US markets. So listen out for that. That's all to talk about on the US 30 though. Next to talk about is the dollar. And interestingly enough, yesterday on the dollar, we did kind of see this downswing, this kind of bearish movement where price went from these, kind of highs, where it was kind of testing resistance, these prior highs made around the 22nd of November. And from there, we did kind of make a significant move to the downside. If I draw out a Fibonacci, kind of a retracement tool here, because it does kind of seem like we're forming a bit of, a head and shoulders pattern, as you can kind of see in here, this kind of shoulder line here and here, baseline kind of here, and now we formed the baseline here further. And so quite possibly, we could be now in a reversal period for the dollar, as we did kind of see, this kind of bearish channel to downside. But obviously this is heavily dependent on the NFP figure that we do receive today. As I did note, maybe not in yesterday's briefing, but the day before, that where price was making these new highs on the dollar, it was likely because central investment banks, and different forms of market actors were trying to get their kind of hedging positions in before the NFP figure was released. So definitely keep your eyes on the dollar, as we have come into contact with this 50% Fibonacci area. So maybe price moves away from that, but keep your eyes on that. That's all to talk about on the dollar though. Next to talk about is Euro USD, which we were mainly talking about in reference to this kind of liquidity level, this Fibonacci level as well. And we did kind of talk about it as the potential area which price may bounce off, but price still hasn't reached that level. We did kind of see a bullish move actually before price even reached it. Therefore, the question is, will price make its way down to this level completely, as we have kind of moved away from it early, possibly after coming into contact with this previous high, as I can draw that out just with my crosshair right there. So keep your eyes on this, but this once again still is the kind of area to maybe note, as price has previously broken below, but kind of tested all these other areas on the Fibonacci chart. So keep your eyes on that. Next to talk about though is pound yen and USD yen, kind of at the same time really, as they both kind of experienced a crash yesterday, and this was largely as a result of increased speculation that the yen would no longer be experiencing negative interest rates, and therefore it sparked a lot of bullish momentum for the yen. We often see this with the yen where it's very volatile, and that's largely as a result of any of this fundamental news that does come out in relation to negative interest rates, does kind of cause these spikes, as we did see here, and as we did see here, and now we're seeing here again. So it'll be interesting to see how the market responds to this, as we are seeing this mirrored both on the on pound yen, but also on USD JPY. So keep your eyes on this. Next to talk about though is Bitcoin, and the question is, will Bitcoin now retrace down to 3820? In yesterday's briefing, we noted that the Bitcoin was kind of stalling out, consolidating somewhat after pushing greatly to the upside. The area which we would then note as the area which price could retrace to, as often when price does have these upswings and then kind of consolidates, we do kind of see these retracements as liquidity is gained for a further move to the upside. So the question is, will price now make its way down to the 3820 area? Quite possibly, and if it does, it does seem like there would be a high quantity of orders within this level, since we have seen that previous accumulation in that area, and it is sitting on that significant 3820 Fibonacci level. So keep your eyes on this. Last to talk about on the charts though is oil, which has now reached this -100 Fibonacci extension level, and of course we are now looking to possibly see a retracement for price. If we were to simply draw out the kind of Fibonacci tool for price, the level doesn't quite line up with this liquidity level, but I'm sure if you kind of try and identify the kind of retracement better, it may line up. But for me, this is the key area for price if it was to retrace to, as we have seen before. Oil as a whole, it likes to kind of break below. It struggles to break lower at first, but it breaks lower and then comes back up and retests. So keep your eyes on oil. That's all to talk about on the charts, though. Lastly, to talk about, of course, is the economic calendar, where, to be quite honest with you, we don't have that much data coming out. Now, firstly, we will be getting the RBA official, an official from the RBA speaking, so maybe listen out for that. As well as that, we are getting a very important figure from Germany, that being their inflation rate figure. That's very important to note, as Germany is the biggest economy of the Eurozone and therefore most important to the ECB. As well as that, we will be getting, and most importantly, we will be getting US non-farm payrolls. And as I spoke about earlier, this will heavily affect US indices, the stock market, and the dollar, of course. So listen out for that. As well as that, and finally, we will be getting US consumer sentiment figure being released. But that's all from us at Wildwood Capital. We've covered a lot on the articles, lots on the charts, and lots on the economic calendar. That's all from us. Have a great trading day this Friday, and have a nice weekend. But that's all from us. Bye.